Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Thursday, March 26th. 2020, and for this analysis we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. We were up 6.13% today on the S&P 500 and finished at 2,627.30. The data may still trickle in and change that slightly. It's just a couple minutes after 4 o'clock when I'm starting to record here, so oftentimes those numbers will change slightly for the first few minutes after 4 o'clock. But right now it's showing the close at 2627.30. So the chart here is a 5-day, 5-minute chart. Each candlestick represents 5 minutes of trading on the S&P 500. These blue annotated lines, this is 2350 and this is 2450. And of course we had, so far during this bear market, we had 2 closes beneath this 2350 level. And then based on the promise of $2 trillion of stimulus, an astronomical sum of money with more to come, the market bounced up here on the 24th and closed above this 2350 level, just below 2450. And any of you that watched the video a couple of days ago, I said right there that it's possible at least we could have a short-term bottom here. And I wanted to see this market close above the 2450 level for 3 days in a row. Now we've done 2 so far. And, that's kind of the way I look at it. I want to see 3 closes above an overhead resistance point. In this case, the 2450 had been that overhead resistance point, and I want to see 3 closes in a row with positive days above an overhead resistance point to say, okay, we really do have a change of direction, at least in the short term. So it really does appear that we have a short-term, or at least a short-term rally going on here, guys, a bear market rally going on. There's no way to know how long this is going to last, but you can see here that, again, a huge day, 6.13% in the S&P 500. That right there, though, should be a cautionary number, okay? The biggest up days in the stock market all happen in bear markets. Historically, that's always been the case. So when you see, 4, 5, 6, 7, 8, 9% up days, that is a bearish sign. Yes, it feels good in the short term, but you only see those types of days in bear market rallies. So just be super careful. Just going to refresh the screen here, make sure we have the best data possible. This is a 1-day, 1-minute chart, so this is just today. So a tremendous amount of volatility, but I want to bring your attention to this candle, this 1-minute candle that happened just after 3:45 in the afternoon today. Guys, look at the size of this candle. That is a 1-minute candle. I ran the numbers on this, and it took us from about 2581 on the S&P 500 to about 2616. That is a 1.35% 1-minute move in the S&P 500 at the tail end of the day. Guys, that's not normal. 1.35% in a 1-minute candle. Now, we finished towards the highs of the session, and that's all well and good. But again, up over 6% for the day with a 1-minute candle that brought us up after 3:45 in the afternoon, brought us up over 1.35%. So is this forecasting a more bullish pattern for tomorrow, or does this become a short-term blow-off top? There's no way to know right now. But again, just be careful because these huge up days are not normal. It's being Fed-induced, and there's still a lot of unknowns out there. So, these bear market rallies, guys, they can be super violent and they're super hard to trade. But what I can tell you is based on my research, this is still a very, very dangerous market. Now, what we're looking at here is a 3-month chart. So it takes us back to just towards the tail end of 2019. Each candlestick represents 1 day of trading on the S&P 500. You can see here the 3-day rally that we have had on the back of the $2 trillion plus in promises from the Fed, and more Fed stimulus to come from the Fed and the government as a whole. And it did bring us back from a pretty negative market. We got down just below the 2200 level on the S&P 500 back on the 23rd. And, we at least have what appears to be a bear market rally at hand. But when we look at a longer term chart here, and let's now go to a 3.5-year chart on a weekly basis where each candlestick represents 1 week of trading in the S&P 500. And what we're seeing here, if we go back to the left and we look back towards the tail end of 2017 and through 2018 right here, what we can see is there's some overhead resistance that's going to be kicking in right here at this 2600 level. And the further we go up, right, assuming we continue to rally a little bit further, the more overhead resistance we're going to hit. So the question becomes, how much of this overhead resistance is going to be a factor as the market goes back up? People that put new money to work back here, they may just want to get out at break even. And I've heard people actually talking to me about that, giving me numbers like, hey, once the market hits 2,700, I'm going to, and why they chose that number, I don't know. But maybe that was just their personal line in the sand or whatever. But, they're telling me that once the market hits 2,700, they're going to sell out their longs and buy puts. So that was just a back and forth conversation I've had with one individual in particular. But it just shows that there are those people that are thinking that way. So this overhead resistance here, starting right around this 2,600 level, as you can see, going clear back into 2017. And just for refresher, prior resistance becomes support once penetrated to the upside, and prior support becomes resistance once penetrated to the downside. So, this area here that was acting as, once we got above it in 2017, that acted as support for a very large portion of 2018 and the latter part of 2017, will more than likely provide some overhead resistance going forward. And of course, the further up we go, the more of that overhead resistance we're going to hit. So, guys, there's no way to know how long this rally is going to last. It's very suspect to me in that we've had such a huge move off the bottom here in a short period of time based on Fed stimulus. These types of days are always suspect to me. And again, you go back and look at the history of bear market rallies. They're extremely violent to the upside, especially when there's promises of Fed stimulus. But it doesn't mean that those rallies last. I have no way to predict the future. I'm just looking at the charts and going off of historical data. So these become extremely difficult situations for all of us. I would be pleasantly surprised, don't get me wrong, but I would be surprised if we've seen the lows already in this bear market. There is just so many unknowns out there, guys, and the longer that companies have to stay closed. And remember, we're not dealing with just the coronavirus. We've got the coronavirus, we've got the oil markets. I think a lot of people are not paying attention to that and the severity of that situation and what that can mean, what the oil market problems can mean for many countries, their currencies, their debt, their deficits around the world. And then, of course, certain places in the United States where there's a lot of oil production. Texas and Colorado are areas in the United States where I know that there's a lot of oil production. And so, there's going to be a drop in revenue in these areas and the spillover effect there over and above what's going on with the coronavirus. And then you look at the knock-on effect of this, okay? And just a couple of other data points here. There's debt-ridden companies may not survive. And I heard of one, I'm not going to name the name, but I heard of one very large, very well-known company today that their debt was downgraded to junk. And this is a major, major company, guys. There's restaurants now that I'm hearing that can't pay their rent, can't pay their leases. There's millions of people that are unemployed, and there potentially could be millions more over the next weeks and months that could be unemployed. And don't forget that 50%, over 50%, depending on the company, but 50+% of the mega cap multinational companies that make up the Dow, the S&P 500, the NASDAQ 100, 50% of their earnings and their sales, their revenue come from outside the U.S. So there's only so much the U.S. government can do to help control that. So there's a lot of unknowns out there, okay? Now, don't get me wrong. There's going to be huge opportunities on the backside of this, but we need to pick and choose our battles. And at this point, the market is extremely risky. There's still so many unknowns. And if this rally does not hold, if we fall back beneath this 2350 level, then keep in mind, we've kind of come down and we check the top of this area right here, this 2200 area. If you see where my cursor is moving, we just kissed that 2200 area, here recently. And so that kind of tested the top end of this support area. But if we roll back over and if we fall beneath this 2350 level, then I still think that the most logical place from a technical area for us to end up at, a technical support area, is this 2000 area on the S&P 500, plus or minus 100 to 125 points. You can see that there was about 2 years of trading in this area starting in mid-2014 all the way through 2016 when we finally broke out and then, of course, checked back, and then the real rally began. So far during this bear market, we've come down and we've checked the top of this area. But again, if this current bear market rally isn't sustainable, and these things to me are always suspect. You always have to be so careful with these things. But if this bear market rally is not sustainable and we roll back over, then we need to prepare ourselves to be somewhere down around this 2000 area, plus or minus, at some point in the not too distant future. Guys, there's no way to know for sure. So far, we've got this, this bear market rally going on. We've stitched 3 days in a row together. But there's going to be overhead resistance now that we're above this 2600 level. And the further we go above it, the more overhead resistance we will hit. So, it's just be super careful if you're long right now, and be in a position to cut your losers as if the market continues to roll over and go against you. Again, based on my work, this is still an extremely dangerous market, and I personally would be very, very surprised if we've seen the lows of this bear market so far. I think there's still too many unknowns. I think there's still too many risks out there. Be careful, be prudent, and if you haven't already done so, please subscribe to my channel. Give me a thumbs up on this video and leave a comment if you would like, and I look forward to seeing you in the next video.